Folks, the 10-year Treasury yield is going bonkers again. It's knocking on the door of 4%, something we haven't seen until after we got the January hot data from an unseasonably warm winter where a lot of retail sales were being pulled forward. The only reason we dipped with the 10-year Treasury in March was, well, of course, the banking crisis where we had a rapid deceleration of interest rates. And then, of course, the time before that was October, November, before the real December sell-off that we saw in the stock market, where we had a 4% 10-year Treasury yield. In fact, as I was recording this just popped from the upper 3.9s to over 4%. So, what's going on and why might these yields be going up? And what could it mean for the stock market? And is there a giant irony happening? I personally believe there is. So we'll look a little bit at positioning, but I want you to think about logic here first, and then we'll get into some equity research from Jefferies and some other sources. So let's think about logic first. What does it mean when a bond yield rises? Well, usually when a bond yield rises, what you have is you have more people selling that particular bond than you have people buying it. So when you have more selling, you increase the yield because the price is lower. So if the yield is constant and the price goes down, you get a higher percentage on your money. But why would people be selling bonds? Well, I have a theory. I think people might be selling bonds because they're realizing they're under-allocated to stocks. Now, that's actually really interesting because it suggests a reiteration of what we've seen in the stock market over especially the last 6 days with the S&P, where you get this morning sell-off or low, and then you rise into the close. It seems to me institutional investors are potentially vastly mispositioned, and every bit of negative news is seen as an opportunity to increase their positioning to equities and reduce their positioning to bonds. Because even though you're getting a nice juicy 4 or 5% yield on the 10 to 2-year Treasury yields, you're missing out on the potential returns of the stock market. And most institutional investors thought 2023 was going to be horrible. We were going to have Chinese reinflation, with the Chinese reopening that was going to push inflation up throughout the rest of the world. Earnings were supposed to be the worst, and the stock market was supposed to sell down even more as a result of this wild earnings recession. Well, we didn't end up getting that kind of pain in 2023. We got a substantially stronger economy with stronger sales in January, stronger sales in February, powered through the banking crisis, potentially with the help of Powell. Although that could reignite as bond yields continue to rise. You actually put more stress on the banks, so you could see more of the Fed's liquidity facilities being tapped because of this. And we have been, right? If you look at the Bank Term Funding Program of the Federal Reserve, and we can pull up charts by going to the St. Louis Fed on that, you can see that liquidity for this facility has generally been trending up. Let's zoom in on it here really quick, and here it is. So you can see here is the banking crisis in March. We shot up with our usage of this bank term funding program. We kind of leveled out, but then come May, as the 10-year Treasury started rising again, you started seeing that pressure again. Now we've started flattening again here in just the last few weeks of June, which is good, a sign of stability. But what could all of this actually mean going forward? And then what does Jeffrey say? Well, consider this for a moment. If it is possible that you end up with an institutional set that is underallocated, that is, people are underweight stocks, which the Bank of America Fund Manager survey told us, hey, we're underweight stocks, right? Bank of America Fund survey said institutional fund managers are underweight 32% on their stocks. Well, then any dip opportunity is an opportunity to buy and allocate and dump bonds, which would actually lead to an environment, and this is the crazy part, where you potentially have yields up, stocks up. Usually you don't have that. Usually when yields are up, stocks go down. But now we're potentially in this environment where yields are going up, stocks are going up because of this rebalancing combined with obviously where the Fed has rates right now. Now, let's take a look at this. Jeffries put together a piece here and indicated that looking at the MSCI hedge fund data as of 4:30, April 30th, and this piece just came out as well, but this just came out yesterday here, July 5. These investors increased their long position to 230%, back above long-term averages. These investors, look at this, lowered weight in bond proxies, underweight group by over 10%, now net short real estate and utilities. Secular growth was bumped to overweight. So many different types of institutions here, but consider this. You've got fund managers, which are your investment advisors. So these are your financial advisors allocating money for people. Then you have hedge funds. So hedge funds are not actually, well, I mean, they can be, but they're usually not licensed financial advisors. They're just people who are putting money together for accredited investors. You've kind of already started to see that transition for hedge funds. They went from underallocated at the beginning of the year to starting to get overallocated as soon as around the end of April. And that could have been one of the reasons we've seen bond yields rise up. Now you need to see fund managers also play catch up. And I think people are realizing that you just can't be short equities right now, or you can't be underallocated. And therefore, you've got here hedge funds raising their equity exposure back above long-term average. Let's take a look at some of the others here. Hedge funds moved back to net short and marginally short net short real estate, marginally short in utilities. I do want to mention what this could mean for real estate, by the way. When you have this sort of environment, by the way, yields up, stocks up, you're actually going to create a very interesting opportunity. Usually what's going to happen is stocks TINA returns for stocks. TINA returns. TINA returns is there is no alternative. And that basically says everyone piles into stocks. There's a beauty in that. As real estate rents decline as they are, real estate becomes less desirable. As mortgage rates and yields rise, guess what? Real estate becomes less desirable, which means much less competition and more opportunity in real estate, because every loser on Wall Street isn't trying to understand real estate and just buy a bunch of properties everywhere. So in my opinion, this actually sets up fantastic opportunities to ride stocks for a bit and then get into real estate as potentially more opportunities open up over the next 6 months to a year, couple of years, in that sort of window. That's sort of what I've been playing and sort of knocking on wood on since January of 2022. The idea of allocate to stocks before the PIV, and then real estate lags, so allocate to real estate after. It's kind of interesting. So, okay, now let's continue with this Jeffries piece. Speaking of real estate, by the way, if you want to shadow me as I hunt for real estate, we brought back the shadowing program, link down below. You can shadow me and learn from me in person on real estate. That's, of course, linked right next to the links for the courses on building your wealth, link down below. All right, so continuing with the Jeffries piece here. So we continue to track and write about our version of FANG Plus, called the Sweet 16. As of the end of April, hedge funds took down their active weight to this group and moved to a larger underweight. The underweight versus the S&P 500 stands at 5.1 versus 3.3% the month prior. So in other words, when you're looking at the top 16 stocks, even though hedge funds have positioned in by about April 30th, in recent weeks, you've started to get back to a little bit underweight. You could see that represented by this red line here. It's really, as we kind of wrote here, hedgies are hit or miss with tech, basically. They're not sure, like, do we love it? Do we hate it? Where do we want to be? And so here's the 0% line. If you see my little squiggly laser right there. And when you get this red line here going under that 0 line right there on the right, you're getting that under allocation again. Which is actually fantastic because it just reiterates why we're potentially seeing these runs of the stock market into the close. Remember, stocks, at least the S&P 500, has run into the close 6 days in a row now, And we haven't seen that since October of 2021. And it's usually a sign of, I mean, I hate to use this phrase, but it might be accurate here, institutional FOMO, where you're kind of just getting this allocation because they realize they've oopsie-doopsied, right? And been misallocated. Hedge funds got less defensive and cut their exposure to bond proxies by almost 5%. Underweight bond proxies now stands at 10.2%. However, the historical average is higher than 11. In other words, they're historically more underweight, which means there's more bond selling to do and more allocating to stocks to do. Now, Augustine here in the chat actually asked a good question. How does this relate to the 10-2 yield curve? Okay, so I said something mean yesterday about economists and the 10-2 yield curve, and it could end up like biting me in the butt, but I thought it was funny. I don't know, maybe other people didn't think it was funny, but I'll show you this tweet, and it relates to answering your question, which I think is actually a very valid question. So first, I quote tweeted this person. This person says, quote, "Son, I got a new job. Mom got a raise. We have more cash in the bank. Gas prices are falling, my 401k is up, your 529 college savings plan is up, and my company is expanding thanks to growing profits. But, son, we're not going to Disney World because the yield curve is inverted." Said nobody ever. And I thought it was a great comment because the truth is, the biggest bear argument right now is the 10-2 yield curve. This idea that, oh my gosh, but the yield curve is inverting. The yield curve being inverted, I know that sounds complicated, but it's really not. Let me show you how simple it is to see that the yield curve is inverted. You ready? You go here, search, you put in 10-year. So all I'm doing is going to cnbc.com, I put in 10-year on one tab, and then I put in 2-year on the other tab. And so what do? Right here on the 10-year, you see, okay, we're at 4%. Okay, that's easy math. Here on the 2-year, you see you're at 5%. What's the difference? About 1%. Because usually you get paid more for committing your money for longer, this is the opposite of what you would expect. You would expect the 10-year to be higher and the 2-year to be shorter or lower, but it's not. Hence, you have an inversion. There are two potential explanations for this. One, we're screwed and we're going into a deep, dark recession like history has predicted. Although there have been false flags on this. Like, if you look at the history of the inverted yield curve, every time there has been a recession, you've had an inversion of the yield curve. But not every time you've had an inversion have you had a recession. Anyway, the second possible explanation is that because inflation is high now, people are demanding a higher basically yield in order to commit to 2-year treasuries now because they want to be paid more now. And they realize that high inflation isn't going to last long, so they're willing to take slightly less on the longer duration bond because inflation is expected to go down. So anyway, I ended up replying to this. I quote tweeted this. It wasn't as popular as I thought. I thought it was funny, but it wasn't. I don't know. I said, hence why economists have predicted 10 out of the last 2 recessions, the actual 10-2 inversion, which is basically to say that maybe the real 10-2 inversion is the fact that we're predicting more recessions than we actually get. Anyway, so point of all this is there is a logical explanation to the 10-2 yield curve. Yes, it is a very legitimate bearish argument. And maybe it's wrong to say that the 10-2 yield curve is completely wrong. And I don't want to suggest that it's completely wrong, but I'm just saying there is a logical explanation as well, which is scary because it makes sense that if you're underallocated bonds, you start dumping bonds in a high interest rate regime. For anybody to buy the 2-year, you need to see yields continue to go up above the 10-year. And then as people are dumping bonds, they're actually throwing money into stocks because stocks are rising again. And we're realizing even though earnings estimates have been adjusted down, things just aren't as bad as they were expected to be in 2022. The economy just continues to show signs of strength. Anyway, okay, a little bit more on the hedge funds here. So I want to see where they're crowded. Here we go. Uber crowded names loved by hedge funds. This is the order of crowded names for hedge funds. Meta, Microsoft, Nvidia, Amazon, Visa, Adobe, Netflix, Evolence Health, McDonald's, Lulu, Lind, Google, Booking Holdings, AMD, Pepsi, Salesforce, PayPal, Intuitive, Procter & Gamble, and United Health. Notice no Tesla. No Tesla, no Apple. Oh, that's really interesting, actually. I'm going to make a little note of that. Tesla, Apple, not here. You also don't have your TSM, your ASML. Oh, by the way, I had the honor of driving to the TSM plant yesterday, which was pretty cool. In Phoenix, we were looking at real estate and studying the rental market there. Here's the Phoenix, Arizona plant as of yesterday. I was talking about how it's really crazy that the Inflation Reduction Act is probably paying like 25 to 30% of all of this, which is remarkable. I actually ended up flying over the plant as well, which was also really cool. So we kind of got a lowish fly over the plant. I mean, that's probably, 4,000 feet or whatever, which is pretty cool. But anyway, yeah, that was pretty awesome. So point of all of this is really, well, here, one more chart and then bottom line this. So Infotech net positioning, you can see here again, I will draw a line at that 0% so you could see it a little bit easier. You could see that negative, that underweight positioning there by hedge funds again in tech. And you can see it oscillates a lot, but that's what hedge funds do. They trade a lot. But anyway, point of this is this Jeffries piece reiterates that funds are underallocated stocks, and when they allocate more to stocks, what do? They dump bonds. What happens when you dump bonds? You jack up the yield curve. And it really reiterates essentially exactly what we're seeing. Just pretty remarkable. So anyway, that gives us a thought about yield curve and stocks.
Now, I want you to know this. When it comes to AI, time is what's going to make you money. And if you can prove that value to an employer, you'll always be able to be employed. So this is another way of making sure that you don't get replaced